Okay, today we see the 2016 question paper of Rani Chennamma University. In this question paper, the 5 marks question number 5, connected with calculation of funds from operation. Okay, so P&L account balance as on 31st March 2016 is given for you people, and thereafter depreciation provided. Depreciation is non-cash operating expense. It is non-cash, no payment of cash. Loss on sale of vehicle. Loss on sale of vehicle is also non-operating expense. It is not related to operation. Goodwill written off. This is also not related to operation. Patent written off. This is also not related to operation. Discount on issue of shares. It is related to capital. Okay. These are the depreciation, loss on sale of vehicle, goodwill written off, patent written off, discount on issue of shares. These are not related to operation. Okay, the depreciation is related to operation, but it is non-cash expense. And profit on sale of building. This profit on sale of building is a income, but it is not related to operation. It is a capital receipt. Okay, and balance of profit on 1/4/2015 is given. This is the opening balance of profit. So out of this, you take the closing balance of profit and add non-operating and non-cash expenses. Okay, thereafter you deduct non-operating incomes and non-operating incomes and non-cash incomes. You see the solution. Okay. 2016 question paper. You take the net profit on 31st March 2016. This is 14,20,000. Okay. For this, you add non-operating and non-cash expenses. One is provision for depreciation 6 lakh. Second is loss on sale of vehicle 20,000. Goodwill written off 20,000. Patent written off 10,000. Discount on issue of shares 50,000. These are all non-operating and expenses. Non-operating and non-cash expenses. So total of this is 7 lakh. You add 7 lakh in the 14,20,000. Now it is 21,20,000 is the total. In this total, you deduct non-operating and non-cash incomes. In the given problem, only one non-operating income is there, that is profit on sale of building. Profit on sale of building 2,50,000. Then you take the last year balance of profit on 31st March 2015, or it is called as 1/4/2015. 1/4/2015 balance you take, that is 5 lakh. So deductible items are 2. Total of this is 7,50,000. You deduct 7,50,000. Whatever balance remains, that is called as fund from operation. Okay, this is the 5 marks question asked for 2016 Rani Chennamma University. Now we see the 15 marks question on this 2016 question paper. This is the 2016 question paper. Out of this, I solved 5 marks question. That is question number 5. I solved this question. Now we see the 15 marks question. Question number 7, question number 8, and question number 9. Omkar Company Limited provide you the following balance sheet. Balance sheet as on 31st March 2015 and 2016. You are required to prepare fund flow statement. Fund flow statement means you have to cover 4 stages. First stage, schedule of changes in working capital. Second is required accounts. Third is fund from operation. Fourth is fund flow statement. And you see here, in this problem, capital 6 lakh, 6 lakh. There is no change. So there is no fund flow in this point. And this reserve and surplus you have to consider. Second note is related with funds from operation. Funds from operation. Remember this. Current liabilities are related with schedule of changes in working capital. Trade payables is there, short-term provisions are there. Then regarding fixed asset is related with tangible asset is related with fund flow statement. Whatever changes takes place in this head, you have to take in the fund flow statement. Then intangible asset you have to consider in the funds from operation. Okay. Then current assets goes to changes in working capital. Like this you have to take. And you see here share capital 6 lakh. There is no change, no fund effect on fund flow statement. You see the general reserve 84,000 to 1,08,000. So 24,000 increase is there. This 24,000 increase you have to take in the funds from operation as transfer to general reserve. The next is P&L account. Opening balance you have to take at the end. Closing balance you have to take in the starting of funds from operation. Then creditors 48,000, 32,400. Decrease is there, comes in the increase column. Bills payable decrease is there, comes in the increase column. Okay. Funds from operation this comes in the schedule of changes in working capital. Provision for tax 96,000, 1,08,000. You take this item in the schedule of changes in working capital if there is no adjustment. If there is adjustment, you prepare the account. Okay. Then building 2,40,000, 2,16,000. So you see here there is a difference of 24,000. I think it is not a 24,000. 14,000, 24,000. Okay, 24,000 difference is there. 24,000 difference, decrease. That 24,000 may be sale of building or that may be depreciation. Okay, if any one item is given in your problem relating to it, 24,000 difference, sale or depreciation, then there is no need of opening the account. Otherwise, you open the account and find out the purchase and sale. Then you see the plant is also change. So you see the adjustment. If the difference tally with the given adjustment, then you don't open the account. Okay. Then goodwill 72,000, 72,000. There is no change in goodwill, so it will not affect the fund flow statement. Then current investment. Current investment 60 to 66,000. 6,000 increase is there. That is the application. Application you take in the sorry. Current investment is it. Current investment comes in the schedule of changes in working capital. So increase is 6,000, comes in increase column. Stock 1,80,000 to 1,38,000. Decrease is there. Decrease you take in the decrease column. Then debtors 1,08,000, 1,16,400. So I think 8,400 increase comes in the increase column. Provision for doubtful debt you take in the current liability. Schedule of changes in working capital. Under the current liability you take, there is an increase of 1,200. You take this one in the decrease column. Bills receivable increase is there, take in the increase column. Cash at bank increase is there, you take in the increase column. Then regarding the adjustment, 48,000 interim dividend. Interim dividend and dividend totally different. You remember it. So interim dividend always you take in the funds from operation and take in the application side of fund flow statement. Fund flow statement. Okay, depreciation 24,000 plant, building 24,000. So building is equal to a difference. In the building account, 24,000 depreciation is there. So you see here also tangible asset, building. Difference is 24,000. Decrease 24,000, depreciation 24,000. So there is no need of preparing the account. But plant difference is not 24,000. There is a Adjustment depreciation is 24,000, but here decrease is not equal to 24,000. Therefore, you have to prepare the account, plant account. Okay. And provision for taxation made is 1,14,000. Provision for tax is given, so you have to prepare the provision for tax account. So in this problem, first you prepare the schedule of changes in working capital. Thereafter, you prepare the two accounts. One is plant account, second is provision for tax account. And third step, funds from operation. Last step, fund flow statement. Okay, you see the solution. Okay, schedule of changes in working capital. Particular 2015-16 changes, increase, decrease. First, you write the current asset. First current asset is current investment, 60,000, 66,000. So 6,000 increase goes to increase column. Second item, stock, 1,80,000, 1,38,000. So here is the decrease. I think decrease is 42,000. So you write that 42,000 in the decrease column. 42,000 in the decrease column. Next is debtors. Debtors 1,08,000, 1,16,400. 8,400 is increase. Okay. Bills receivable 12,000, 19,200. So 7,200 increase. Next, cash in hand 39,600, 91,200. So there is an increase, that is 51,600. Okay, these are the current assets. Now you take the total of current assets. First column 3,99,000. Second column 4,30,800. Okay. Then you take the current liabilities. Creditor 48,600, 48,000. Next column 32,400. So creditor decrease is there. Decrease in the creditor comes in the increase column. Next, bills payable 7,200, 4,800. So here also there is a decrease. Decrease comes in the increase column. Next, you write the bills payable and don't take the provision for tax, because for provision for tax there is an adjustment. So you open the account. Provision for bad debt, deduct in the debtors amount is 2,400, 3,600. So there is a decrease of increase of rupees 1,200. That 1,200 goes to decrease column. Okay, and you take the current liability total. First column total is 57,600. Second column total is 40,800. Okay. Now you calculate the working capital of first year and second year. That is A minus B. First column A minus B is 3,42,000. First year 2015 working capital is 3,42,000. Then working capital for 2016 is 3,90,000. So it indicates that there is increase in the working capital. Increase in the working capital. So you write that increase in the working capital and take the total of third and fourth column. Third column total is 91,200. Fourth column total is 43,200. Okay. So you take the difference of first and second column. That is called as increase in working capital. You record in the deficit column, difference is 48,000. So that 48,000 is called as increase in working capital. Increase in working capital. In the same way, you take the difference of third and fourth column. So difference is 48,000. You write in the deficit column. Okay. Now you take the total. The total is 3,90,000, 3,90,000, and third column total is 91,200. Last column 91,200. Okay. Now you prepare the required accounts. One is plant account, another is provision for tax account. So first we prepare the plant account. Two balance brought down. Opening balance is 2,22,000. Opening balance is 2,22,000 and closing balance is 2,16,000. 2,16,000. Okay. Opening balance, closing balance. And depreciation given in the adjustment is 24,000. You write by depreciation. This is the information related with plant. And close the plant account and ascertain the balance or difference. So 2,40,000 is the total of the account. Difference goes to purchase of asset. So write to bank, in the bracket you write purchase. The difference is 18,000. 18,000 is called as purchase and this is the application. Okay, this is the application. Now you prepare the provision for tax account. First you take the buy balance brought down 96,000. Opening balance is 96,000. Two balance carried down. Closing balance 1,08,000. Then in the adjustment they have given provision for income tax during the year. So you write that as by P&L account 1,14,000. Okay. Now you take the total. Total is 2,10,000. 2,10,000 is the total and difference is called as income tax paid. So to bank account. To bank means tax paid 1,02,000. So tax paid goes to fund flow statement as application. And P&L account provision is item of funds from operation. Okay. Now you prepare the funds from operation. Statement showing funds from operation. First you take the closing balance of net profit, that is 78,000. Add non-operating and non-cash expenses. Under that, first you take the depreciation. Total depreciation is 48,000. Total depreciation is 48,000. That is 24,000 on building, 24,000 on plant. Okay. Thereafter, you take the transfer to general reserve. Difference between opening balance and closing balance of general reserve. 24,000 is there. Increase in the general reserve is nothing but it is the transfer to general reserve. Okay. Then interim dividend paid is 48,000 you take. Okay, interim dividend paid. And next is provision for tax you take. Provision for tax. Account from your account, you take that amount. Provision for tax. 1,14,000. You take the total to the outer column. So that total is the 2,34,000. So 2,34,000 plus 78,000, 3,12,000. 3,12,000 total. Then you deduct non-operating and non-cash incomes. Non-operating and non-cash incomes are only one, that is the opening balance of profit. So you take the opening balance of profit 96,000, deduct it, you will get from operation. So funds from operation is 2,16,000. 2,16,000. Okay. And now you prepare the fund flow statement. Okay. In the fund flow statement, first you write the funds from operation. Funds from operation is 2,16,000. Thereafter, you write the purchase and sale of assets. Purchase of plant is 18,000. Okay. And there is no sale of asset. And there is no source of fund, that is no issue of shares, no loan taken or no sale of asset. Therefore, you take the other applications, application of fund. One is plant, second is income tax paid. You take this amount from your account balance, difference, income tax paid, dividend paid you take, then you take the decrease in working capital. You take the decrease in, you take the increase in working capital on the application side, not decrease. In the problem, increase in working capital is there. You calculated, you take increase in working capital on application side. If the decrease is there, you take on the source side. And take the total of this. This total of this is 2,16,000. 2,16,000 is the total. Okay.